Sponsored by Chartered Financial Strategies. You are now watching Tax Bites.
All right, welcome to another episode of Tax Bites, and today starts a series called Tax Planning the Myths. And this myth is basically the first one we're going to talk about is roughly the idea that clients think that when they're going to do tax savings advice, tax planning is a little bit strong, but even just tax advice to how to save or reduce taxes through some kind of planning or late season in the tax season or whatever, what can they do to save on taxes? They think, or there tends to be a belief that for every dollar they do put towards some kind of tax savings effort is a dollar reduction in taxes. And really, that is a very big misunderstanding for how tax savings works. And I'll show in a basic calculation here as we have basically kind of two scenarios. One is between an employee who decides to put money in in a 401k, IRA of some sort, really 401k, and the self-employed who's got the same option through a self-employment IRA type savings. And you got the scenario where they don't, and the scenario there, and the scenario where they do on these two here. And basically, not getting too complicated in the calculation, it's going to be a married filing joint standard deduction. You're going to have the difference here between taxable income is roughly the $15,000. Over here, it's about $12,000 through some a little more complicated calculations. But your basic difference in tax between the employee version is about $1,800 and about $1,400 for the self-employed. And so you look at that, and that's about 12%, 10%, somewhere in that range between your gross income and your tax savings. And clients will typically go, hey, it's late in tax season, I want to do something, what can I do? Can I put money in an IRA? Yeah, you put money in an IRA, or open up a SEP, let's put money there. Well, what's the difference in tax if I do that? Well, it's about a 10%, 12% savings in tax, meaning for every dollar you put in, you're going to reduce your taxes by 10 cents, 12 cents. And typically clients go, that's not a big deal for me. I don't want to do that. And the reason it becomes so, I guess, unaccepted or lack of buy-in is because they're expecting a big bang for their buck purely on tax, when the real tax savings is that money can grow over time tax-free until you obviously distribute out in retirement. And so the buy-in is expecting everything to happen in income tax right here and right now on this year's return. And that's not the value. The value really is that tax planning of this nature or tax advice of this nature must tie into a larger goal. Here, the larger goal would be retirement. Sometimes the larger goal is asset protection. Sometimes the larger goal is, some other nature, some other aspect of financial matters. But taxes in itself isn't always the primary, or largely it's not the primary driver of a financial plan. It's a larger goal that you're tying into. And the tax planning either makes it more efficient or is kind of secondary at times to that larger goal. For here, again, the larger goal is saving for retirement and saving in a tax advantageous way versus just putting $15,000 aside in an account, no tax impact whatsoever. So that's kind of the tax bite, is that I guess the myth is you think you're going to get a dollar for dollar reduction in your taxes when you do some kind of tax advice or get some kind of tax advice to follow. And the reality is you really need to tie that tax advice to a larger financial goal typically. So I hope it's been insightful, something valuable today. As always, like, share, comment, and subscribe, and have a good day.